Chapter 15, Company Structures. So the key point in this chapter, only a limited knowledge of company structures is required in the Introduction to Bookkeeping unit, which we tested more fully in the Business Awareness unit. The reason for each structure is a trade-off between liability, control, disclosure, ability to raise capital, and taxation. So you're expected to have an awareness of company structures, which were tested further in the Business Awareness unit. Before setting out each structure, it's worth understanding the trade-off and applicability of each structure to understand how and why each structure was formed. So you've got these various different factors here, which we're going to go through. So in terms of the factors determining company structure and trade-offs, so imagine a world where if a company was bankrupt, the shareholders can be sued with unlimited liability. A very large company, so let's say Enron, goes bankrupt, and pensioners who invested in the company via pension schemes are now having their homes repossessed. They had nothing to do with managing the company, they were simply members of the public investing in the company, but they now have unlimited liability as the owners of the company. Such a position would be unworkable because it would be impossible to raise funds. No one would invest in companies, and the economy, as we know, would collapse. Alternatively, imagine a world where there's no liability at all for failure. A plumber who works on somebody's house and it subsequently collapses can simply shrug their shoulders and move on to the next job without any financial consequence. This would not be fair, and again would be chaotic. So throughout company structures, we've got these trade-offs that appear, really, and they're based on the types of liability that we have and size and whatever. So I'll take you through them now, really. So we've got liability versus disclosure. So a company or partnership can limit the liability of the shareholders in the event of financial collapse. So it gets limited to the amount of shareholders' funds. However, the price of limited liability is disclosure based upon the size of the company. Such disclosure costs in terms of time to produce, orders as fees to provide an opinion on whether the disclosures are materially true or fair, and intrusion into the business of providing financial data. So for example, a publicly listed or quoted company's poor financial performance being continually published in the press can be damaging to the company's morale and standing with customers, and for that reason they are often taken off market. So therefore there's this trade-off between limiting shareholders' liabilities and the disclosure of information about companies. That's trade-off number one. Trade-off number two, the ability to raise funds from wider sources versus the cost. A sole trader can raise capital from themselves and the bank, typically a house against a loan. This is relatively simple and low cost. A listed quoted company looking to sell shares to the public has to generate unauthorized sales prospectus for each capital fundraising, has ongoing disclosure with shareholders, and has non-executive directors on its board providing oversight. This is a high cost, and such that it needs to be shared amongst a large amount of shareholders for the funds to be worthwhile. There's therefore this trade-off between the amount of shareholder capital that needs to be raised and the cost of raising that capital in terms of finances, scrutiny, and restrictions on decision making. Number three, so ability to raise funds versus threats to control from outside interference. So a sole trader or partnership has very high controls of the operation of the business. Another person will not appear overnight and tell the sole trader that they're no longer running the business and their plumbing van and customer list has been taken over, and the new person, Bob, is now in charge. A company listed or quoted on a stock exchange can simply have another party buy their shares and replace management. Such hostile takeovers are rare, but in reality, it's more for typical disgruntled shareholders to demand a breakup of the company, sale of certain divisions, or replacement of managers. There's therefore this trade-off between the ability to raise funds and control. So size of company that invests in demand. So whilst a sole trader may want to sell shares to the public, there's a practical problem that the wider public, typically pension schemes, will not be interested in the investment. There are appropriate investors for each size of company, and certain organisations may either be too large or too small for the corporate structure, and therefore they change from one structure to another based upon the amount of effective cost that's involved. So taxation and oversight. So charities don't have to pay tax. So there's a company structure called a charity, and they call themselves a charity, and then they have oversight, which is very heavy oversight from either the Charities Commission, or if they are incorporated by statute. So they're a charity incorporated by statute, there'll be oversight by the government. Yeah. So typically, let's say academies and school providers, that kind of thing, would be charities overseen by the government. And typical sort of guide dogs for the blind kind of thing is a charity overseen by the Charities Commission. Now, the advantage of a charity is that you can raise funds as a charity, and people like to give money to charities, and also that's all tax free. So you don't have to tax. Charities have limitations on the amount of taxation that they have to charge. Still have to charge VAT if it's applicable, but they don't not subject to corporation tax. The downside is significant oversight and actually the ability to control what they do. So a charity can't raise money for one thing and then decide to go and use it for something else. And then, in terms of the last one, then defined managers. So, in terms of a sole trader or a partnership that's not limited by liability, well, they are the people there. A sole trader won't move to a partnership because it needs to sort of work with some other people, and therefore have a partnership agreement. But then we get to a point where we've got these companies, limited liability companies. Now, in that instance, then we have a situation whereby we can have some defined managers, directors. Now, it doesn't mean that there's unlimited liability in this sort of limited liability. I think the company always has unlimited liability for everything in there. It can't limit its liability on the actual company can't limit its liability. But the directors similarly could become liable for the losses if they continue to trade while insolvent. They'd also can be liable for things like money laundering, or liable for things like corporate manslaughter. So you do have this sort of liability position sitting on managers, but you have this sort of defined managers position as well. So now we've got our various trade-offs. We're going to go through the structures. So sole traders is a person who trades on their own, running a business. So they might employ other people, but they are the sole owner and fully responsible for the liabilities of the organisation. They have unlimited liability, but the highest level of control over decision making and no disclosure requirements. Partnerships. A partnership is a number of people who have come together to own an organisation and trade together. The extent of their ownership, the share of assets and profit and losses is determined by the partnership agreement. If they don't have a partnership agreement, then all profits and assets are shared equally, regardless of who brought them into business. It's therefore important to have an agreement before entering into partnership working. Key areas of dispute with partnerships is whether the parties were in a partnership at all. So are they in a partnership at all? Because then obviously if there's no agreement, then we all share the profits and the assets equally. Or alternatively, whether one party thinks the other one's not contributing sufficiently compared to what was agreed. Partnerships may have unlimited or limited liabilities, and limited liability partnerships have similar disclosure requirements to companies. Private limited companies. A private limited company is one which cannot sell shares to the public. So it's almost like a not a public liability company. We'll see that in a second. Really, a limited liability partnership has the liabilities are limited for shareholders, and as a result, there are disclosure requirements. So accounts to be filed with the company's house and that kind of thing. Really. Public limited companies. A public limited company can theoretically sell shares to the public. In reality, it cannot share to the wider public. The shares can only be marketed to the wider public if it's via an authorised prospectus, which is expensive to produce. Instead, most PLCs are structured for the benefits of appearing to be a larger company. So in terms of this one, which is always, can sell shares to the public? Not really. It can't really sell shares to the public. There's a limitation, which I think is to about, it can market to 600 people, but after that it has to produce a prospectus. Those prospectuses are incredibly expensive to produce, require auditors producing 3 years worth of audited accounts. So they have to go back and re-audit the accounts for 3 years, and there's a whole amount of things that have to be put in the prospectus. It has to be absolutely accurate. So there'll be accountants, and there'll be lawyers, and there'll be the printers. And it's very expensive to go through and actually sort of really sell to the public. Just in case you decide to come up with your own personal thing that you're trying to flog on Facebook or whatever. Right, companies sold on a recognised stock exchange. So these companies do sell shares to the public because they're quoted on a recognised exchange, such as the alternative investment market. They would be quoted on the alternative investment market, or they're listed on the main stock exchange, a listed company. They are PLCs because they must be able to share to the public, but they've made their share sales, initial public offerings or subsequent share sales via authorised prospectuses. These companies need to be large because a listed company really needs to be approaching £1 billion in value, so £1 billion in value, to not be subject to a discount in value of basically buyers not really wanting the company, in order to generate an interest from shareholders. Those shareholders, typically pension schemes, require liquid market in their shares, and hence large companies with lots of shareholders to buy and sell shares to. However, if these companies are large, the returns required by shareholders will be lower than for other investors, such as venture capitalists or private owners or whatever. These companies are subject to the very highest disclosures and rules of oversight. They can be subject to hostile takeovers or management being forced into actions. In terms of limitations on liabilities, the company always has unlimited liability. It's the shareholders whose liabilities are limited for any losses. The company may be sold as a going concern. If a company cannot pay its debt, it will be wound up and all the assets sold. So the company's unlimited liability, it will be wound up and sold. Either it will be sold as a going concern to somebody else, or it will be terminated, which is struck off the company's house where the corporate body will no longer exist. Directors of a limited liability company may also become liable for losses if they continue to trade while knowingly insolvent or act recklessly. And in recent years, management have also become liable for areas such as corporate manslaughter, money laundering and bribery, which can carry criminal convictions.